What's up? What's up? What's up? How we doing, everybody? Happy Tuesday, December 7th. And this is Jason Allen John. And this is your All Things Finance Mortgage News. I'm excited to come to you guys today with a couple of things that, is near and dear to me. And being able to talk about this to you guys has been great. So having said that, let's just get right into it. So our foreign homeowners empty homes to blame for Canada's unaffordable real estate market. Canadians embark on $193 billion of debt over the pandemic, and now comes the day of reckoning. Mortgage surge helps fuel the banks, and observers grow a split growth for 2022. Canada's red hot real estate market to lose steam in 2022, but affordability still is going to be tough. And then we're going to talk a little bit about Evergrande. Evergrande is this big debt crisis that's going on in China, one of the biggest builders. So we're just going to get right into it. So the first thing that we're going to talk about is we're going to talk about the bank's earnings. So the bank's earnings have been fueled by mortgages. And it's actually crazy the amount of, energy that the mortgages put to it. So Canada's big banks report strong mortgage growth in originations over the past year, fueled by the country's hot pandemic housing, but have different views on whether that strength can continue in 2022. Now, what do you guys think? I think the strength is going to continue. I know rates, there's going to be some issues, but let's just get more into the article. So looking forward, we expect mortgage growth to be strong in the high single digits rate, supported by low interest rate, supply and demand imbalances affecting prices, increase in immigration activity, says David McCain, RBC's president and chief financial officer, at the conference last week. Now, this article just talks about all the different banks. Now, Ron Butler, who's a mortgage broker like myself, says the volume of originations, like how many billions of dollars of new mortgages originated this year, it's been great, but it's not going to be as great next year. That's because interest rates are going to be going up, and sometimes the banks revert to NIM, which is net interest margin. So when rates go up, their net interest margins get better. So even in that case, the bank's numbers are still going to be amazing. So it's going to keep up. It's going to keep going for the banks. The earnings are going to be good. So what does that mean? It might be really good investments, really good dividends. Like as you've seen, they all raised their dividends over the last few weeks. But the way the mortgage market is structured is that a very, very, very low risk products for the banks. High loan to value mortgage have insurance underpinning them, so there's no risk to them. So the rate of loss for the banks under that product, which is the riskiest category, is basically nil, because CMHC or Genworth covers that. Or Sagan, sorry, got to say the right name. They cover that right now. So for the banks, and that's why, if you've ever noticed when you're looking at the rates, you're like, why are people that put less than 20% down actually paying lower rates than people who put more money down? You would assume it would be the opposite. But the reason is because, like we say right there, the risk to the bank is basically nothing because CMHC takes on that risk for them. So for them, they love to lend out that mortgage because essentially they get to package it off, take it off the books, and go to the other route. So that's why, there's a little bit more flexibility on if you put 20% down because it's more within that bank's risk tolerance, so they could take it. But anything less than 20% down, they're really tight on the metrics and the numbers, on the GDSR, which is gross debt service ratio, and the TDSR, which is total debt service ratio. Let's just continue on with the article. So, going forward, it's going to be interesting to see if those non-mortgage volumes rebounded. So we're going to see the banks most likely continue to put into strength. Like, the banks are some of the biggest employers in Canada, and like they're very, very interested in keeping things standard and keep going with the market because you could see how it's very profitable for them. So the next article we're going to talk about, it was going to be like how much debt us Canadians have got into over this pandemic, right? So it's very, very interesting to see what's going on. So Canadians embarked on 193,000 in binge mortgages during the pandemic. And now comes the day of reckoning, right? Because the rates are going to go up. So we got to deal with that. So let's get into this article and talk about what it's going to talk about some more. So low interest rates loving Canadians have lapped up $193 billion in new mortgage debt during the pandemic, taking the total household debt to a record $2.5 trillion. But the party is about to end, as a result of the central banks look to take the punch bowl away from the US Federal Reserve and the Bank of Canada have both signaled a faster return to monetary tightening next year as they pull the interest levers to tame inflation. Now, mortgage debt accounts for 68.7% of total household debt, compared to 65.9% at the end of 2019. And that could be predicated to the housing prices going up, right? And again, I always say people pay in payments, not on the price of the mortgage. So if Bank of Canada raises policy rate from 0.25% in the fourth quarter of 2022 to a neutral level of 2% by mid-2026, households' increased payments are forecast to rise as a share of disposable income from the record low of 6.3% in the third quarter of 2021 to 8.2% by the fourth quarter of 2023. We estimate this will add $86 to the average monthly mortgage payment by Q3 2023 and $236 by Q4 2026. Another red flag is low quality mortgages now make up a quarter of all mortgages combined, compared to the 14% in 2019, underscoring the vulnerability of some households to higher rates. So again, we're going to keep going on this. More Canadian households are expected to be sensitive to the rate movement, as the quarter of the outstanding mortgages by September 2021 were on a variable rate compared to 18% in 2022. February. The share of new mortgages with loan to value ratios above 450% jumped to 22% in late 2020, led by an increase in highly leveraged uninsured mortgages. This is well above the recent peaks in 2016 and 2017, and most recent data from Bank of Canada suggests that the share rose to over than 25% in early 2021. Which is really, really big. Like that's a big increase, right? So again, what does that mean to you? And what does that mean to us? Like, we gotta take care of ourselves. So one strategy that I tell a lot of my customers is that if you're on a variable rate, why don't you pay as if it's a fixed rate? And what I mean by that is that you could calculate your rate as a fixed rate mortgage and pay whatever mortgage payment you want. So if interest rates were to rise in the future, you will be protected by the fact that you are already paying a higher fixed rate. However, you're being charged at the variable rate. So all that additional money just goes straight into principal. And people love that. It makes things a little bit easier, and then it helps you adjust when rates do change. So the next article we're going to get into is the one that, I feel like a lot of people always talk about: foreign buyers in the Canadian market. Like, what's the deal with the foreign buyers? So you can see, are foreign owners of empty homes to blame for Canada's unaffordable housing market? The new BC data lands at relevant national moment. The new BC data lands at a relevant national moment. The federal government, as of January 1st, is bringing a 1% tax to non-residents, non-Canadian owners of vacant land, underused housing, including the foreign tax vacant lands for big city. The city of Toronto also plans to start a tax on vacant homes in 2022. Like the original BC taxes, these moves aim to increase rental housing supplies and lower rental prices by penalizing investors who don't rent out their properties. So what do several years of data from similar levels from Vancouver and BC reveal? Three things. One, vacancy tax seems to be working, with more investment properties becoming rentals. Second, the rate of overseas ownership in Canadian real estate may be lower than thought. And third, while foreign owners are paying these new levies, some are actually Canadian investors. So it's actually not like all foreign. And I think it gets really construed when people think about corporations. They always think about corporations as being foreign owners because you don't really know exactly who's the actual owner. So Vancouver's newest data released the past week found that 1,627 empty homes paid tax in 2020, one quarter fewer than 2017. Empty homes, including 4,227 of them that earned an exemption, accounted for 3% of all homes in the city. Since inception, the tax has raised $87 million that's gone towards affordable housing. In the mid-2010s, 10s, there was a lot of debate, finger pointing over overseas investors, but the absence of data, no one really knew what was going on. The data flows, the debate continues. A review by the numbers by a UBC professor and a local analyst find noticeably lower rates of foreign ownership than does Statistics Canada. StatsCan estimates foreign ownership of City of Vancouver housing at more than 6%. The research pegs it close to 2%. In my opinion, I think it's closer to 2%. I don't think there's a lot of foreign ownership as much as people think. I just think we have very tight supplies. And, it's easy to point the fingers on the foreigners, but it's not them that is really causing our issues in the housing market. It's really our lack of supply. And you can really see that now with a lot of the things that's going on. And it's the supply that's really getting us. What are we going to do about that supply? What is the government going to do? Or what are the builders going to come into play? So let's talk about the market now. So now, we talked about foreign ownership. We talked about how much money the banks are making off of the mortgages. Then we also talked about how much debt the Canadians have gone into. So in 2022, just, coming up in about 23 days, 24 days, what are we going to expect? Like, what is it? So, is it going to continue? Let's just see. So this poll was actually done by a variety of real estate professionals in the market. So Canada's double-digit housing price inflation will lose steam next year, but affordability is almost certain to worsen in one of the world's hottest property markets, according to the poll. Now, let's just get into some of the stuff that some of these analysts and participants in the real estate market talked about. So asked what's the biggest impact on housing for the next years, 9 out of the 14 respondents said higher interest rates and tighter monetary policy. So that's something we just talked about. And then the remaining said supply constraints. So supply constraints, higher prices, higher interest rates, which leads to higher mortgage payments, which leads to higher unaffordability levels, right? 1 or 2 rate increases is unlikely to have a meaningful impact. But if we see 4 or more increases in 2022, this should take some demand out the market, especially from interest rate sensitive investors, right? And that's from John Parsley, from the president and brokerage of Realosity Realty. And they do a lot of research, right? So again, we don't see investors, house flippers, and speculators, according to the Bank of Canada, account for over 20% of the home purchases. But I think that's aggravated. You need people like that to create more housing supply. So it's an interesting dynamic that we have to go through as a population in determining what is the best and where's the best way to go and what is the best thing to go at, right? So what's the next thing that we're going to do? You know what I mean? What's the next thing that we're going to talk about that is actually going to, we're going to actually talk about the similar article, but there's just a little bit more details in this one from the Financial Post that I like. So we're just going to continue on what we were referring to. So it talks about, again, it's gonna wane. But some of the things that they talked about this is, there was a rush of homes that purchased that was expected because people are expected rates to go up. So next year, October went up 8.2% compared to a year earlier. Affordability is not likely to improve as next year's prices should remain much higher, even as interest rates creep upwards as well. So the economist at TD, who expects housing inflation to slow considerably over the next year. We think rate hikes will weigh on, but not upend demand, as macro backdrops still remain supportive for sales. And that's a lot to do with, in immigration coming in, people moving up, and just population growth in Toronto and GTA and across Canada. We're growing at a rapid rate. But those increases that we've been seeing are set to slow down significantly. 5% in 2022, 2% in 2023. And according to the poll of 50 market analysts, which was conducted on November 17th to December 6th and released on Tuesday, that compared the rise of 3.2% and 2.6% in the August poll. So you can see that, the slowdown is starting to happen. Only 2 respondents expected prices to fall modestly in 2023. And asked what's the biggest impact of houses in the next year, again, they said higher interest rates, we talked earlier, and 5 cited supply constraints. A follow-up question on interest rates hikes would significantly slow the housing market activity at a median forecast of 100, with price predictions between 75 to 175 basis points. Like, we're going to see if rates are going to go up. My opinion on that, rates ain't going nowhere. And that's something that we gotta all talk about, and we gotta see. Like, I think the bond prices, and we're gonna get on that on Friday. We'll talk a lot about rates, and we'll get into the charts, and we'll look at the charts and stuff like that. So overall, what do you think? Like, what is it to do? Like, what do you do in this situation? So we're seeing banks make more money. We've seen Canadians take out more debt, but we're not seeing relief to the housing market, even if prices fall. And the thing about it that's very unique, and something that I actually wanted to talk about today, is that, I was speaking with one of my clients, and what was very interesting, they were referring to the fact that the government doesn't want the prices to fall. Because if you think about it, the large base of voters are mostly property owners. So if you are a property owner, you don't want your price to fall. Yes, you want affordability and you want people to buy, but you don't want it to be at the detriment of your housing prices. So do you think there will ever put a policy that will help lower the prices on how it affects so many individuals' net worth in Canada? I don't think so. I don't think that's possible. So anyways, that's the show for today. Thank you for joining me. I'm excited that you're along on this journey. We're going to keep this going. See y'all tomorrow.